To this day, all the successful traders that I know tend to incorporate more than one time frame in their analysis. It's important to look at the hourlies in conjunction with the dailies, or the daily charts in conjunction with the weeklies, to get more of a three-dimensional picture of the overall structure of the market. It will make a difference in your trading in the long run, the more time frames you incorporate in doing your analysis. The second thesis that he put forth is that the market will always move in action-reaction. Okay, well, that sounds like a pretty basic type of concept, you know. You're always hoping for that reaction when you're on the wrong side of it, right? And that's when you don't get that reaction. But as a general rule of thumb, the market's going to alternate back and forth in these types of waves or sequences. The next thing that he said is that the markets do tend to trend. And here's an interesting comment I have to share with you. I had been trading on the floor for a number of years and had been a trader for about 10 years. And I was a member of the Market Technicians Association. And finally, through the prompting of another buddy of mine, he's like, hey, let's go up and get our CMT test, which is this certification that you actually know what the technical analysis is. You know, I'm like, I've been a trader for, you know, a number of years. I know that kind of stuff. Well, you start reading and you start to realize how little you know. And one of the questions they asked was, what is the definition of a trend in terms of classical technical analysis? And if somebody had asked me, it's like, well, you know, the market's going up. Well, how do you define that the market is going up? You know, are you going to measure it by moving averages? Are you going to measure it by if it's broken through a channel? And Dow was the one who classically defined his trend as having a higher high and a higher low. You have to have both of those to define an uptrend, and a lower low and a lower high defines a downtrend. Once you have defined that sequence, then you can go on to extrapolate the odds favor, or the probabilities lie that that trend will continue. Maybe not 90% of the time, but then that would be where the odds would lie. And ultimately in this game, that's all we're doing is quantifying probabilities. So Dow contributed the definition of a trend. The last two important things that he set forth were volume works in conjunction with price, and most people are very aware of the fact that volume tends to increase in the direction of the trend and dry up on the reactions. And then the last thing that he put forth was that the market will, at times in its corrective process, make a line, a sideways line. And he defined what the line was. And that, too, sets forth a basis for a trade plan at a later point. You know, we can look at lines all the time in the market, sideways lines, congestion areas, consolidation areas. And again, this was part of the foundation that people then went on to, with point and figure charting, to quantify the lines and where they projected.